and in front of you you can see a screen, the 90 minutes of the future for the S&P. But anyway, I'll hand you straight over to Tom Williams. Tom.
Yeah, hi everyone, Tom Williams here. Lovely to talk to you. It's been slightly chaotic the last week or so. I had a head cold last week, which tended to put me off. Well, I couldn't speak properly, so I apologize for that. But touch wood, seems to have disappeared now. Now, Gavin apparently is coming on 6:30, continuation when we finish here. And so he's all happy because he recommended a stock and it's shot up, of course, which is a good show. Now, what we have up on the screen is a 90-minute chart. Now, the only reason why I could say it's a 90-minute up here, Gavin must have put it up sometime, because that's the length of a soccer match in the UK, 90 minutes. Now, all these different time frames work. It doesn't matter really. Some are more clearer than others, of course. That's why you need to check the different time frames. But the reason they work, different time frames, is because imagine, I know I've told this story before, but say you're a doctor in a hospital and you've got a patient who's either getting better or getting worse. It doesn't matter really where you check up on every minute, 5 minutes, every hour, every 90 minutes, or whatever. It's not going to change his progress. He's either getting better or he isn't, or he's getting worse. And that's why all these different time frames work. Markets, without question, move on supply and demand. That is supply and demand. If you bury this in your head, supply and demand from the activity of the professional players. When we say professional players, we're talking about people that trade 50,000 contracts and not blink too many eyelids over that, right? And of course, it's that various amounts give you the various differences in the volume below seen on your chart. So when that volume is high, you know the activity is high, and so on, and you'll gradually get the knack of reading that. It's nothing, we don't use mathematical formulas. It's really, well, what's the word, Peter? Intuition? So, eh? An art, Peter says. And you will learn the art. Now, I put this 90-minute up, and there's no end of opportunity here for you to make money, because the principles of supply and demand, right? Now, right on the low here, hang on, right on the low here, we have our old favorite, the shakeout. Now, we know, we've seen this time after time. Well, stopping volume, the computer says so. Okay, but it's really a shakeout. Well, it might be stopping volume. It's a shakeout. Yeah, that's right. Now, we know the S&P 500 loves to do this. They ram it down with alarming falls, enough to put the fear of God into anybody that happens to be the wrong side of the market. This shakes the market out, catches no end of stops, encourages people, some traders may decide to go short. In other words, they'll be on the wrong side of the market. This creates opportunities for the professional money to buy into the market, right? Now, okay, we've got this shakeout. This is a huge sign of strength, right? And when you look at that, you must realize this is a serious sign of strength. Now, we have other principles that confirm this. And the ones that seem to show up on this chart, they do all the charts really, most of them. These intraday charts is what we call a test. If you were writing a book, how would you describe a test to me? Well, what you would do, you write down a test is a down bar. The volume is low. It's probably closed in the middle or high. And the spread is narrow. Now, when you see that, it's telling you loud and clear that the professional money cannot possibly be selling, and therefore you expect higher prices. So as the market moves forward, right, we get our sort of temporary red arrow look. And I've told you this many, many times in the past. If you see a test after a red arrow, it makes it very bullish. So bang, what's that? So we look to see what the computer tells us. So down the bottom here, look. Somewhere, if I can find it. Here we go. Here we go. What is a test? It's a down bar, yeah. You've written that for your book. Volume is low. In fact, it's very low, look. Wow, the spread's narrow. This is closed low. It didn't close in the middle, but it doesn't matter. The main criteria of a test is there. It's a down bar. Volume is low. Spread is narrow. The narrow spread means that they're not pushing the lower prices. That's what causes the narrow spread. The volume is low because they're not busy selling, right? And there's a down bar. So there's your opportunity right there and there to make money. If you miss the shakeout in the background here, if you miss that, okay, you should not miss this because they're happening all the time, these tests. So up it goes. We've got another red arrow here. The market falters slightly. But bang, what's this? Let's see what the computer says. Is this a test? Let's see what it says. The bar is down, yeah. This is what you wrote in your book. A down bar, volume low, or very low, look. Spread narrow, close the middle. You've got the perfect test. And you should recognize that the light bulb should be turned on immediately. You see that? And I think if you miss any of these principles, if you're a serious trader or not doing this as like a glorified hobby, you need to write down, why have you missed that? What was the reason you missed that? Ask yourself and tell yourself on a piece of paper, why did I miss that? And that might be the answer for you. Have you been busy? You go out for coffee or out for breakfast or something? Or why was the reason you missed it? Right? So I believe there's another test here, look. The higher up you go, the more nervous they get. And they will start wanting to test more. So I look down the bottom again. There it is. Bar is down, right? Volume is low again. Wow. Spread narrow. Close the middle this time. So that is a perfect test that you've written down in your new book describing what test is. And the market moves on supply and demand. If there's no supply on a bar, you'd expect higher prices. Okay? Now, if you miss these, write down a piece of paper, write a letter to yourself, why did I miss that? You might say, well, I wasn't even looking at it. Well, that's the reason why you missed it. Or were you too busy? Are you too busy to make money? Well, what are you doing? Ask yourself a question, why did I miss that? And that may help you to recognize. But look, so that's 3 tests we've seen already, look. Not to mention the shakeout down here. All right? Okay, so the market goes up. Keep telling you, there's no supply. Now, we've started to get a few red arrows here. As I always say to Gavin, ignore the signals at your peril. May not be all that obvious to you, but the computer certainly looks at the facts it's given. That's it. Doesn't look at anything else. It can't look at anything else. All it can do is look at the principles that you've told the programmer to put into the program. And so the market's hesitated. It doesn't mean to say it's going to collapse into a bear market. It just means that supply is entering the market somewhat, and the enthusiasm from the upside, which we've seen in the background here, is probably going to wane. Now, please tell me, are there any questions? Rita's here looking at a computer screen. Peter is. We're all poised to answer any questions. So please ask anything that you like, and I'll do my best, and we'll do our best to answer it. Rita's no word from Rita yet. Hang on.
Hi, Leslie says the ES is at resistance on the daily chart. Could you please comment?
Well, it probably is part of resistance. That's why the red arrows are coming in. Is that a daily chart? Look how it bounced off that lower trend line. This is a daily chart, of course. So, right, this is up to date, is it, Pete?
It's live.
Oh, it's here.
Last bar hasn't finished yet.
Right. So this is a daily chart, and we noticed that yesterday it looked bang, hit that lower trend line. That's why trend lines work, why they're important, why professional players often, some of them trade on it. Some of them have ordered, on these trend lines, or at or near them, to buy. Because when these market makers shove this market down, it may only be down there for a minute or so, but long enough for them to fill the order at nice low prices. So if that looks like stopping volume, right, fair enough, but it's not going to go into a bull market yet. It can't go into a bull market for the simple reason is there's no cause built. You have to have what they call a cause. In other words, this market has to chop sideways for a bit if they're buying, accumulating. And you know what we would like to see? We like to see this market chopping around a bit like this, and they eventually come back down to this level where we first saw this volume here. And if the volume or activity is low, that's testing this area. Markets move on supply and demand. Therefore, if the market falls and the volume or activity is low, it means there's little or no supply present where at the level there was. So any supply has been dealt with. It's been absorbed, bought, shaken out, whatever. we don't ask too many questions. We just know the principles and follow them. It's a waste of time if you ask too many questions. What's happened there? Right. Can you put up, we looked at 90 minutes. Put up 15 minutes. That's kind of, yeah, that's it. That seems to be quite a time period people seem to like. So this is a 15-minute chart, time frame. And lo and behold, we still get the same principles busy at work. Look, there's your shakeout. Right, there's a bit of no demand, so they test it, look. Right, this is a 15-minute chart. So let's see what the computer bar is down. Volume, there is a bit of supply here. Spread average close in the middle. There's a little bit of hesitation on that bar, look. Right. And that's why they test it again here, look. So what's the computer say about that one? Bar is down, volume is low. Sorry, the mouse keeps flicking around. Right, there we go. Bar is down, right. Volume is low now. Spread is narrow, wow. Close lower, that's fair enough. But the main criteria here is that the spread is narrow, so there's no downside pressure at all. Right, that's what makes the down bar narrow, is there's no selling pressure on the lower end, and the volume is low, backing it up. Right, so there's the test. This one back here wasn't all that clear. Right, so they have another one, look. That one is clear, and bang, that's why it goes up, look. Now this is a 15-minute chart. So all these principles are there. You don't have to be too clever, just follow the principles. Get to know in your head what a test is or what it looks like. A shakeout. What supply looks like when it hits the market. High volume and up bars. Or an increase in volume and up bars. And don't forget, if you get a red arrow, right, they may test it. If it's tested, it means it wants to go higher. Now, it's 15 minutes. Any questions on this one? Hang on, read it.
Okay, yeah, there were a few questions came through after we'd switched things. So if we go back to the 90-minute one chart, Louis is asking, would you stop the highs of those tests and place a stop below on an intraday time frame? And Jenica says, would you get in the trade on the second blue up bar?
Well, these sort of questions are all really, I can't tell you that really, because every trader is different. Your sense of risk and all the rest of it is different for almost everybody. Your skill as a trader will kick in once you recognize the principles and they're buried in your head so that when they occur, lights come on. Now, the thing is, you cannot tell the market what to do. You cannot tell the market, so that's definitely categorical, you cannot do that. Okay, you know that, everybody knows that. You can't tell the market what to do. So what you have to do, you have to sit back and be patient and wait for a principle to appear. When it appears, you recognize it, turns on the light bulbs when you see it, and bang, you're in. Now that's really, I suppose, the difficult part of trading. It's not supposed to be easy. I mean, learn the principles, but that's only the first step of knowing the markets move on supply and demand, and it's the activity of professional money that you're looking at. Knowing that if there's no selling pressure on their behalf, they want higher prices. All right, so please, you need to get the principle right, and then your skills of trading will automatically kick in. But we're all different. It's no good me saying, oh, well, I do this and I do that. Your ability as a trader will automatically kick in. It has to for your survival. But if you understand the principles and don't trade until you see a clear principle, I mean, admittedly, this chart is a 90-minute chart, so every bar is 90 minutes. That's a hell of a long time to sit there waiting for the rabbit to poke his head up through the hole. You know, admittedly, that's what makes trading difficult. And that's why in the future we're going to try and, well, we will overcome that eventually, because we're going to have an automatic program that will warn you when these things are happening. And I don't know what will happen when we get that going, but Gavin's in charge of all that. Any more questions?
There was a test that you must. One thing is, Philip Friston has. Hello, Philip. Said Tom, fantastic explanation by you about tests. Very clear, he said. And on the subject of tests, Donald is asking, that test, no, it must, I think it was on the previous chart, that test has closed right at the bottom. Is that normal on tests? Were we on the day?
Well, you see, you mustn't tie yourself down. Yeah, you mustn't tie yourself down, or it must close on the low, or this. The main criteria for test is obviously it has to be a down bar. There has to be usually, well, there always is, some sort of strength in the background, or weakness has suddenly appeared, like a red arrow perhaps. The main criteria is a down bar, and there's no selling pressure, and that presents itself with the narrow spreads closing usually, the word usually, middle or high, but it can equally close on the low. It all depends. But don't let that put you off. The main criteria is the down bar on a narrow spread, and the volume is low. And if you see that appearing after any signs of weakness, like a red arrow, especially no demand, then it means that things going to go up. It's as straightforward as that. You're looking at what the professional players are looking at. They can see all this. What do you think they base their decisions on? That's why they base their decisions. They're not looking at mathematical formulas and worried about this and that and Bollinger Bands and all this nonsense. You know, they're not looking at all that. They just stand there, look at the screen, and they're trading on supply and demand. They're trading exactly what we're telling you that you should look for. It's great for scalping, believe me.
This is Grigory, Tom, is saying, looking at 6B, we'll put the daily up. That's the pound. Yeah, so he's saying this looks interesting today. It's weak at the moment. We've broken a very important support level on the daily, and even small time frames like 5, 15 minutes, hourly have no serious strength. A bit high volume on the ongoing 4-hour bar, but we will be able to analyze it on Monday when the next 4-hour bar will have closed. I cannot see any serious support levels on the 6B high time frames. Yeah, closer than 200 points down from the current price. So have you got any comments, Tom?
Well, before Tom speaks, just to say, I noticed that Gavin put an alert out for this yesterday morning for a short near the top of that current bar, so that worked out. Tom?
Well, thank you for that input, Gregory. Gregory is our Russian programmer, right? And he's obviously knows what he's talking about, which is wonderful. Now, this is the British pound we're looking at. And, I mean, you've only got to look at the background. I mean, God, look at this. Well, that's it. Look at that. How's that for an upthrust? Yeah, well, they're not kidding. That it's technically not an upthrust, but it is an upthrust. It looks like a telegraph pole on top of a hill, look. Whenever you see that, after being a substantial up move, which we've seen, right, then you're going to get lower prices. However, on saying that, there it is, bang, right in front of you. We witnessed that, I remember it. Right, so anyway, the next day, look, nothing much happens. But then the following day, look, we've got no demand, up bar. There's a signal on it. What's that say? No demand. No demand. There are the computer spots it straight away, look. Now, a dumb computer, looking at a few lines of code, it knows, so you should certainly know with your clever brain. Right, there's a weakness, and up it goes on no demand. Look at that. There's a narrow spread with high volume, not going anywhere. That's being supplied, really. It is, yeah. Well, that's supply as well, though. Professional money on this next bar, look, is fully aware of that weakness here. So up it goes. Look at that terrific high volume. They're selling like hell here. Right? And then they mark it up further to squeeze the last drop of blood out of it. And that's up on no demand. And it's serious enough to produce a signal log. So there's your confirmation. There's your weakness. There's weakness. And there's your confirmation. It's all very, very, very clear. Now, you may get a green arrow come in like this, but you ignore that if the next bar is not up. Right. Because remember, to move up, you have to have what we call a cause. There has to be accumulation. Now, a widespread down here, like we're seeing at the moment, Gavin gave a short out at the top here. Widespread down like that, as it rushes towards former areas of support, is normally bearish. But that's only an observation. But we have to read it as it unfolds, as Gregory said. But there's a weakness. I mean, I remember we witnessed all that. I remember talking about it, pointing it all out to various people, but they are. Any questions?
Philip says the ultra-high volume should be on the previous bar, the huge upthrust. E-signal put the volume on the daily chart 1 bar to the right.
Well, thank you for that, Philip, but that's possibly true. You know, the volume is so important. Why do you think they're doing this in this sort of underhanded way? Because they know that anybody that knows the market knows how important volume is, or activity. So Philip said most of that volume on this bar here, that one, is part of the previous day's activity, which is almost disgusting when you come to think of it, seeing you've got to pay for this information. But despite that, that is an obvious sign of weakness, and there's an obvious sign of weakness with no demand. And you've either got automatic signal that come up to remind you of that fact. If you miss this, write down on a piece of paper, why did I miss that? Why? What was the reason? Perhaps you wasn't even looking at it. So that's the reason. Ask yourself, why have you missed these?
Ken is saying, when Tom says up on no demand, is he referring to up on low volume?
Yes, I am. I describe no demand. Imagine you're at a public auction and say you're an antique dealer and you're sitting there, there's other antique dealers there as well, right? But the auctioneer wants to know if there are any mugs in the audience willing to pay over the odds. So what did he do? You see him do it all the time. They mark the price up. If you know a piece of pottery is worth $200 and he says now, right, $400. Start off with 400, right? What happens is that there's little or no response to that markup. That's no demand. Why? Because they know it's not worth $400. They know, professional money, know that weakness is in the background. It's pretty obvious to see. You can't miss that, really. And they certainly are fully aware of that. And when the market makers mark it up to see if there's anybody around, right, willing to come in, right, at these higher prices and get caught and possibly get a few stops as well, right? If the volume is low and you've got that weakness in the background, and that's no demand. And the computer picks it up. I mean, there's only a few lines of code there telling the computer to do that. So I'm sure you can work that one out, can't you?
Do we have crude? We don't have crude oil real time, do we? We have something. Have we got anything else as an alternative? Oh, right. Okay, Leslie, we don't have crude oil real time. Leslie's saying it appears to be no demand at 90. We don't have the data for that. Shall we look at the daily though, folks? Can you put it up? Are you going to put, yeah, they're just putting the end of day chart up.
Right, just updating. Here it goes. Sorry, Rita, what are we looking at?
Crude oil.
Crude oil.
Yeah.
Daily chart.
Yes.
All right. Now the commodities like crude oil and corn and wheat, they're professionally driven, there's no question about that. And very often the principles are clearer because of that. But saying that, it's still a dangerous place to be. Right. So it seems to be in a downtrend, and it's obviously supported this previous level. That looks like a bit of a test there. That test, Peter?
Basic test.
So, yeah, crude oil is showing a basic test. Now, that doesn't mean to say it's going to shoot off to heaven, right? You need a cause. In other words, if it's going to be bullish, you need some buying. Now, admittedly, the buying could be in the top here, round here, but it doesn't appear to be stopping volume here. But this certainly looks like stopping volumes coming in here. So you can't really do anything with this until you let the story unfold. If you see a down bar anywhere sometime in the future, right along here somewhere, right, and it falls back down to this area, and the volume is then low relative to this volume, then you're going to get higher prices. But you may get a few up bars now, but you would expect that high volume to be tested. So if it goes up a few bars, don't say, oh hell, I've missed that. Wait for the principle to appear. You can't tell the market what to do. The market will tell you what it wants to do. And when it does it, you should, as a skilled trader, recognize the principle. And if you don't see it, don't worry. There are plenty of other charts to look at. Okay?
Adrian is saying, can you show the trade of yesterday on the pound, which you sent the alert on, 5 minutes and 15 minutes? That's one for Gavin Holmes. Yeah, if you repeat the question, he's coming on in 20 minutes. Gavin Holmes, ask him because he put that alert out. There's a question here from Winston, Tom. I have a few questions on the scan. What are the important factors to bear in mind when reading the scan? What is it telling us when there are green indicators above the red time frames and red indicators above the green time frames? Sometimes there are a series of red and green indicators in a shaded background. Sometimes you see 1, 2 or 3 indicators isolated in a rectangle. What do all these things mean? Is there information on any of the websites that can provide information on how to read the scan? So, Peter, can you hear you speak?
Hello, Winston. Yeah, it's Peter here. Yeah, Tom doesn't use that personally, and I don't personally, so I can't really answer your question. So Gavin's on later. He may well have a good take on that. So I suggest you, if you haven't already, copy and paste your question back in later when he's on. I think he's probably going to be able to answer that. Rita?
Okay, could you put GC up, Peter? Yes. Leslie's saying it dropped to 1190.3 today. Now it appears to be testing ? Well, we've only got the daily, so Tom can only comment on that.
Yeah, well, this is gold. All we got is a daily chart. But first glance, the whole thing still looks weak, doesn't it? I mean, the market's weak, but you see all these up-thrust-looking bars, look. That's weakness as they probe it up, trying to catch stops and mislead people. Right. So the market's falling. There's nothing obvious. It's not easy market to read because there's so many amateurs in there. That's what I was saying about wheat and corn and that. At least the principles are very often quite clear because they're professionally driven. But this to me does not look basically strong at all because of these up-thrust type bars, look here. You may have a little bit of stopping volume here, that's why it went sideways a bit.
Today it has dropped down lower, Tom.
Has it?
Yeah, below.
Oh, well, they are.
In the hour it has tested, and I wouldn't like to go long.
No, oh no. No, to me, it looks basically dodgy, put it that way.
Okay, so you don't have any more questions on this screen at the moment, Tom. So do you have, yeah? Oh, hang on. Leslie says cocoa is very interesting. That's CC. We got cocoa. Cocoa. There it is. It should be going up because of supply impacts in West Africa, but it plummeted.
What? It should be going up because of news. Well, we know that we don't listen to that nonsense. We can clearly see if this is cocoa, but this is a small distribution cap up here. Look how it rounds over. This rounding over like this. And these up bars look no demand. So this does not look good at all at the moment. So I certainly wouldn't say there was any strength in this at all at the moment. Okay.
On that, it's Peter here again. On that subject of news, a couple of years ago, I heard some news or saw some news on the internet that there was a sugar shortage worldwide. I think it was 2 years or 3 years ago. I forget now. And so I looked at the chart for the commodity of sugar and saw that the market had gone up, and it had now had quite a bit of volume coming in. In other words, there appeared to be oversupply on the charts, and sure enough, a few days later, it fiddled about and then came down. Now, that was in the face of everyone being told there's a world shortage of sugar. So obviously that didn't match the chart nor the reality. Some months later, I checked again. It could have been a good 6 months later. And funny enough, some African growers had voiced the opinion. They said, well, we don't understand why everyone was saying there's a shortage of sugar. We've got too much, was basically what they were saying. So that's a lesson, really, that the chart tells the story rather than the news. So the news can be used, Tom, is that right, by various bodies to do one thing or the other, cause other people to do one thing or the other.
If you're a professional player of sugar, right, you want to manipulate the views that other people have. Now, of course, sugar would be what they're aiming at is these people like Cadbury's who need at least 2 years guaranteed. Who? Kraft, yeah. At least 2 years of supply of sugar for their businesses. So these people who run these businesses, they're not really stock market readers. You know, they hear these rumors, they say, well, come on, we better buy here, so we've got enough supply for at least 2 years. And that's what's going on. Basically, as you all know, you cannot rely on the news as being, shall we say, the gospel truth, and nothing but the truth. It's there, news is usually there to influence as many people as possible to buy or sell. So at the end of the day, the professional people are holding all these contracts or supplying the contracts, finish up making money.
Philip is saying that cocoa distribution started on 23rd of July this year. There, I mean, I'm not sure Tom can see this. Can you see that? There. Can you see where I'm down here?
Yeah.
There. So Philip's saying that's where the distribution started. Do you want to say any? So, yeah.
Thank you for that, Philip. Observation. Philip says this is the start of distribution here. There's your high volume look. On up bar, enough to produce a red arrow. Right, well, it says enough thrust. It's not really an up thrust, it's supply. Markets don't like ultra high volume and up bars. Bang, that's it. So we assume that's, Philip says, the start of distribution. So they hold the market up as much as possible while they're selling more and more and more. Right, little bit no demand here. And then what gets most of the traders, even if you're clever enough to say, oh, that's weakness, I'm shorting this, then the upthrust catches you. It catches many, many traders, and that's why it's there. This is a true upthrust, right? Upthrust, yeah. Yeah, well, that's a clear upthrust look. And why is it an upthrust? Because you've got weakness in the background. This hasn't gone away, look. This doesn't just disappear. The bad credit record's there, look. It's in the books. Right? Professional money are fully aware of that. Right? So then they say, right, okay, now we'll catch them here. We'll have a nice up thrust. We'll ram it up. Catch loads of stops. They'll make people think it's now going to go into a bullish move. Only collapse on the lows, and that's it. And really, this move here too is also an opportunity. They moved it up. It's really like a longer term up thrust. But that's distribution as well there, look.
Winston is asking, when you sit down to read your weekly chart or any time frame, what are the key things you are looking for that will tell you we have a bull or a bear week or time frame?
Well, I just described it when we looked at the 60-minute chart, 90-minute chart at the start of the seminar. We had a shakeout. Pretty obvious then. There it is. As soon as you see these we know the S&P likes to shake out. We know it does this all the time. And the down move behind. And we also know it likes to test the market to make sure that it is bullish. Right, and lo and behold, there's a test. All these red down bars were tests. We looked at all that, didn't we? Now we saw some red arrows appearing here, an increase in volume, so we know there's a bit of hesitation in the up move here. Supply is hitting the market. Ignore the signals at your peril. But you can see that where that market, once you recognize that as a shakeout, look, you've almost got to be blind or dead not to see that as a shakeout, look. Sorry. Reed's having a giggle here. But it's true. As soon as you see that, you know the market's probably bullish, especially when it's testing. See, testing, look. If you learn nothing else but recognize a test, we call that a test in a rising market. It's the principle of ESA.
Okay, shall we finish then, Tom, on, shall we look at the ES on a small time frame? Because Gavin's going to be coming on in about 8 minutes. And there are no more questions here. So do you want to put less time frame? 15 minutes?
15 minutes, yeah, the ES. Okay. Well, we saw the hesitation, the few red arrows coming